The average true range, or ATR for those who like acronyms more than actual words, is like that one friend who's always on top of things, updating continuously and giving real-time readings based on price movements. This real-time data helps traders assess market conditions more effectively than a weather app during a tornado alert. Thanks to its adaptability, it fits snugly with various trading strategies, like your favorite pair of stretchy pants. Now, while most traders have a love affair with the 14-period ATR, they often forget that adjusting the period is like tailoring your suit. One size does not fit all. Go for shorter periods if you want more signals than a traffic jam, or opt for longer ones if you prefer fewer interruptions. Think of it as quality over quantity, like the difference between a fast food burger and a gourmet meal. Understanding market cycles is as crucial as knowing when to apologize after forgetting your partner's birthday. The ATR helps traders spot periods of expansion and contraction, kind of like seeing the waves before they crash at the beach. This insight allows traders to make informed decisions based on market volatility, enhancing their overall trading strategy and, let's hope, their bank balances. Speaking of market phases, consolidation is like that awkward phase in a relationship where you're not sure if it's just complicated, or if you're actually going to get married. Chart patterns resembling rectangles, triangles, or flags indicate that the market is taking a breather before making a big move, kind of like gathering your courage to finally ask the cute barista out. When the ATR is low, traders should channel their inner Sherlock Holmes, scrutinizing the overall trend, supply and demand zones, and candlestick formations to predict which way the market might sway. Because let's face it, when prices are low, it's like watching paint dry, there's tension in the air, and a big move could be just around the corner. A long stretch of low ATR is like waiting for your favorite show to come back from hiatus. It hints that when the price finally moves, it might be something dramatic. Traders should be on their toes for a potential breakout or breakdown. It's like waiting for someone to drop a mic at the end of a tense argument. When it happens, it's going to be loud. Let's talk about the chandelier exit. It's not just a fancy light fixture, it's a dynamic volatility-based indicator that adjusts based on price action. This helps traders figure out where to place their stop-loss orders without feeling like they're throwing darts blindfolded. Think of it as setting your alarm clock. You want it just right, not too close to your pillow. Choosing the right ATR period and multiplier is like finding the perfect recipe for your grandma's secret sauce. Get it wrong, and the whole dish suffers. These choices influence the distance of the chandelier exit line, impacting trade management and risk. Choosing wisely can turn your trading results from a bland meal into a 5-star dish. Implementing the chandelier exit involves identifying market trends and waiting for very specific signals. It's like biding your time at a karaoke bar for just the right moment to grab the mic and belt out your favorite tune. This ensures that traders can make informed decisions during entry and exit points, minimizing the chances of sounding like a cat in a blender. The chandelier exit isn't just for show, it helps lock in profits as it adjusts with price movements. Think of it as a lifeguard for your trades, keeping them safe while you sip your piña colada. Just be careful not to forget your sunscreen or your stop loss, or you might end up crispy and burnt. Incorporating additional analysis methods, like price action and key levels, is essential when using the chandelier exit, much like seasoning your food to avoid it tasting like cardboard. This boosts your trading decisions and gives your strategy the pizzazz it needs to impress your friends at dinner parties. Because who doesn't want to be known as the trader with the secret spice? The ATR bands indicator is like a pair of old binoculars, offering a dynamic range for expected price movement. It's designed to help traders assess market volatility, but let's be honest, those bands are lagging indicators based on historical price actions. It's a reminder that while history is important, it shouldn't be the only thing guiding our future. Otherwise, we'd all still be using flip phones. Next up, we have the Super Trend Indicator, a fabulous creation derived from the ATR that helps in identifying market direction and potential signals. When it changes colors, it's a visual cue that screams for attention, like a toddler with a crayon, and tells traders when it might be time to buy or sell based on price positioning. Staying aware of the ATR before trading can seriously enhance decision-making in the market. It's like knowing the difference between a glass of water and a double shot of espresso before a big meeting. One keeps you calm, the other might have you jittering under the table. With a solid understanding of the ATR, traders can better ride trends and maximize those sweet profits. In conclusion, remember that trading is less about throwing spaghetti at the wall to see what sticks and more about using tools like the ATR and chandelier exit with finesse. Toss in some humor and a little patience, and you'll be navigating the markets with the grace of a gazelle, albeit a slightly clumsy one, but hey, at least you're still on your feet.